Hey everybody, welcome back to the channel. Today, the question is, are you a veteran? If you are, and you were looking to buy your first home, or you're selling a house and you're looking to buy another home, but what has held you back is affordability and interest rates, then this video is going to be for you. We're going to be discussing a unique veteran program, a VA program that can help veterans get in at interest rates that, well, I don't think that most of the other consumers can find their way to. So I have with me today my friend Chris Coulter. So if you like content like this, please give us a thumbs up, subscribe to the channel, give us a comment below. It helps out with the algorithm. With that, I'm going to go ahead and say hi to Chris, and we're going to get this thing started. Hey, Chris, how's it going?
Jason, as well. How are you doing?
I'm doing
Thanks
great.
for having me on your show.
I appreciate it, man. So VA loans, they haven't been a big part of the market much lately, but they're kind of making a resurgence on this type of thing. And I think affordability has a lot to do with that, because even qualified veterans that qualified for a VA loan, a lot of times, unless they had a disability certificate that waived the funding fee that VA charges, a lot of times it made sense for them to do a conventional loan, right? You know, just because when the rates were lower, a conventional loan would be less in fees and potentially less of a payment if they had a down payment.
Correct.
Now, obviously, a veteran that wants to go in with no money down, that is an option they have with the VA loan that it's perfect for. But with the rise of prices and rates, affordability's kind of been crushed a little bit.
Definitely.
Are you seeing some possibilities with VA in terms of pricing?
Yes, absolutely. With the advent of this program, we are definitely seeing some solutions for veterans to get to price points that previously they weren't able to in this market with VA rates or
Okay.
with current prices of homes. So yes, this is definitely a solution that we're going to talk about today.
All right, awesome. So let's start from a 10,000 foot view and describe what a VA loan is and what some of the fees are, and so we can cover some of the misconceptions on them. So first and foremost, let's cover these three things. Qualification,
Okay.
what has to happen for you to be able to get a VA loan, down payment requirement for a VA loan, and is there a price cap for the VA loan? If we can understand those three basics, that can help people to understand where they're at with it. So can you hit those?
Absolutely. So the VA loan is a benefit that veterans receive after serving in a particular branch of the service. Most veterans are going to know if they qualify for this benefit, but in general, you have to have served on active duty for 2 years. And it is a loan program, a mortgage loan program that entitles them to not have to put any money down. That's
Okay.
the main benefit to a VA loan, is that it's a 100% financing.
Got it. Okay, so that's great. So no money down. They've had to serve with this. So the term there used is an eligibility certificate.
Yes, certificate
right?
of eligibility is the document that qualifies them to have that VA benefit.
Okay, so I know you said most know that they qualify for it, but I've met a lot of veterans that don't know how to get that or where to go. So what does that process look like, just briefly?
Sure, they can call us. All of that.
Obviously, that's a great one. In fact, below in the video, we're going to have Chris's contact information. It's also going to be linked down in the description, that if you just want to skip past go and on the Monopoly game and go straight to getting qualified, this is the guy to give a call to. But aside from that, who would they contact?
Even if they just have a question about their eligibility, we have access to VA's database, which keeps all of the veterans' information and eligibility online. So all we would need is a DD-214, which is basically a separation from service, if they are separated from service, or we need their service number. And we can go online and we can tell them whether they've got the eligibility. Alternatively, if they would like to call the VA directly, the VA has an Atlanta Regional Loan Center, VA Atlanta Regional Loan Center.
Okay.
You can call them, and they're very helpful, and they can discuss the specific entitlement, is what it's called, or eligibility with the veteran directly and tell them whether they qualify or not. So call the VA Atlanta Regional Loan Center, or they can call me, and I can look online and tell them as well.
All right, so that's how we find out if they're qualified for a VA loan. What did you say the cap was?
2 years of active duty service?
No, loan amount.
Oh, the loan amount cap I didn't say, but it is $747,250.
Wow,
That's
right down to the penny.
$747,250 is the maximum VA loan. In certain scenarios, they can go above that.
That's why I just wanted to kind of briefly reference that,
Yeah.
but that is not at the no money down.
That's correct. They do have to put some money down when they get above $747,250. So
right. So if you're in other words, if you're buying something at, let's just say it's $850, in that scenario, you're not going to be able to do a no money down deal. You're going to have to put money down, but your benefit can be there. And the other thing I wanted to point out for veterans is that depending on percentage of disability, if you were wounded in combat or the VA has deemed you to have some level of disability, this can affect in a positive way the amount of money that you pay on a VA loan. So we're going to get into, VA loans don't, even though they don't have a down payment, they don't have private
monthly
mortgage insurance or MI of any kind. And so what they do have is a funding fee, which I'm going to consider that like upfront mortgage insurance, to cover that. What I do know is I've seen several clients that had a certain level of disability. I don't know what the percentage or the break is, but where that has been waived or greatly reduced, making it where they're getting a great rate with no money down, no MI, and no upfront fee is possible. You just have to find out what you qualify for, and Chris can help you do that. Is that fair?
That's fair, absolutely. So just to put some numbers behind that, the funding fee, if you've never used your VA eligibility or VA entitlement before, is 3.3%. Okay, so that's a hefty amount.
Ouch.
Yeah, so if you're
especially at today's prices
at $100,000, that's $3,300. So your loan amount.
Let's talk about today's price at $400,000.
Yeah, it's $12,000 and change. So instead of taking out a $400,000 loan, you're taking out a $412,000 loan, which is more than you're paying for the home. So that is a drawback on a VA loan. Many times it's worth it if you don't have a down payment and need that feature. Then the funding fee gets added onto the mortgage. It's not something that you pay out of your pocket. But yes, it is increasingly these days, in my experience, a lot of people are exempt from that funding fee due to a service-related disability. I would say of the VA, of the veterans that we've qualified in the last, let's say, 12 months, I would say greater than 50% of them have had a service-related disability that exempts them from that funding fee.
Wow, greater than 50%?
It's very common that you're exempt from that funding fee. So you will know that. I mean, a veteran will know that, of course. They'll know their percentage of disability, and they'll know whether or not they have an exemption from that funding fee typically.
And if you don't, for whatever reason, we can find out, right? So if you have a suspicion or you don't quite remember, that's something that can be looked at. So that gets us into the zone of saying, okay, so VA loans have some really cool benefits for veterans. You guys can do them. They don't have to go through a VA bank of some kind.
No.
So they can work with a lender who basically what all you guys do is loan origination and refinances, right?
That's correct.
Your bank doesn't do checkings and savings and CDs. You guys are in the mortgage business. And so you're fast, you're efficient, and you have expertise in this area to help veterans out.
And we have VA loan underwriters on staff.
Right, and that's a special qualification they have to have.
Not every lender has that, but we have delegated VA underwriters, and so we're very familiar with the guidelines and qualifications, entitlements, and exemptions, and all of those things.
Okay, cool. So now let's get into the unique program stuff. So one of the things that has kind of recently surfaced is, interest rates are higher than people want them to be, not as high as they were like last year, but still high. And affordability has gone down because prices have continued to climb, not nearly as fast, but still, we're. If you guys saw my live broadcast with Trend Talk, you know that appreciation is up quarter over quarter for 2024. We're up. Even though, all of this is still going on. And so getting the rate down, if we can't get the price down, is the only way to control payment. True or not true?
True.
Okay. So with that in mind, talk me through, without going into too far into the weeds, let's share a story of this unique program that you were able to take on a VA, loan and help somebody go from not qualifying to qualifying to buy something that was even more expensive while keeping their payment in line.
Okay. So let's first talk a little bit before we get into the story about the actual program, because it's an add-on, if you will. I'm going to call it an add-on. So you have a VA eligibility and a VA qualification that veterans are entitled to. In addition to that, there's another government organization called the Department of Community Affairs.
Okay.
They also have a loan program that they will use in conjunction with the VA loan to subsidize an interest rate. Alternatively, if it's not a VA loan, they will do down payment assistance. Okay, so they will have funds available that are government funds that have been appropriated by Congress for first-time home buyers that are under certain income levels that will allow them to not put any money down. Now, as a veteran, you don't need that benefit, so they use the funds for the veteran to subsidize the interest rate.
Got it.
Okay, and so it's a very below market rate. So it's about, in general, 2 percentage points or more below what current rates are on a 30-year fixed rate versus, say, a conventional loan.
Okay, so I know we can't quote rates because everybody's, first of all, it's free market and the market changes by the minute.
It's around 5%.
Okay, it's around 5%.
Yeah.
And so that being said, just so you're aware, if normal rates are at 6.875, 2%, if that were linear, would be 5.875. So that puts you into a much higher affordability range. In fact, for the same payment, that 2% should equal what, $60,000 worth of buying power?
It does. Actually, in some cases, I've seen it in the example I'm going to give you, it was actually about $90,000.
Oh, wow.
Put them into a price point that was $90,000 higher than what they were originally trying to purchase a home at or be comfortable with a payment at.
Okay. So before we get into that story, I just want to frame this for the audience. So the VA loan program, eligibility certificate, step 1. Step 2 is the government subsidized program that he just mentioned in there, being able to be used on a VA from since VA has no money down. They don't need to use it necessarily for the down payment assistance part of it, but instead it's being used to subsidize the rate and bring the rate down. So if you're not familiar with what subsidies look like, basically what they're doing is they're taking some government appropriated funds from Congress and they're prepaying the bank the profit they would have gotten on the difference of that interest, is the way I'm going to frame that. That may not be the exact mechanism, but by paying those fees, they're able to buy the rate down. So the end consumer on a month-to-month basis, the veteran who served his country, will be paying an interest rate that you cannot get on other loans. And it's approximately about a 2% difference. In some cases, more, which he's going to talk about in a specific example, but that was changing the type of property they were buying. But I wanted to make sure that was clear on this. So if it's about the 5% where we're running 6s and 7%, that's fairly significant. So if you're a veteran and you've been shut out of the housing market, you may want to give us a call about this. All right, now I'm going to turn it back to Chris, and I want him to tell the specifics of a story of somebody. We'll omit the names. We're going to call them Billy Jean. Billy and Jean.
Billy and Jean.
Billy and Jean, because so that we're protecting people's privacy, and we're going to have a conversation about Billy and Jean. So go ahead and take it away. Tell us what you did with Bill and Jean.
For these folks, first of all, I'll tell you that the rate that we were able to lock in for them was 4.875.
Oh my!
So that's not a rate. That's not an interest rate that we've seen in a while.
No, that was like, what was that, mid 2022?
Yeah,
and then at the end of 2022, it was like, oh, there's a blip in the radar that has hung with us.
That's exactly
it's
right.
Like the storm cloud that
I had to
leave.
look twice at the rate to make sure it was right, and I had to make some phone calls to go, is this right? This isn't right. This is what's the,
Are you sure?
What's the deal here?
Are you sure?
But it is right. It is correct. And when we got wind of it, we really started learning about the program, talking about the program, and finding the benefits and the folks that this could benefit. And that's why we're here today talking about that, trying to find folks that don't know about this program, and so we can educate them on it.
Right.
But yeah, we had a young couple that came in and qualified them over a year ago. And they were looking, at a price point, their comfort level they had just had a new baby, and they were a single income household.
Got it.
And they were looking, their comfort level payment was about, equaling a purchase price that was about $260,000.
Okay. I just want to say for this, $260,000 is a challenging price point anywhere in the surrounding counties. I don't care if you're talking Pickens, Cherokee, Cobb. That's a hard price point to get something that you would want your family to live in. So right there, they're challenged just in general to be able to do this. So that's awesome.
And they didn't do anything for about a year and a half. They sat there and just said, well, we're not going to be able to get into the housing market. I can't find anything in that range.
There's so much of that happening right now where people are just like waiting for something better to come along. And what I fear is what's going to come along later is going to be more expensive and worse.
Absolutely. Fast forward a year and a half, and they call me back, and they're like, all right, we've got to do something. We're renting. We don't want to rent anymore, paying somebody else's mortgage. He had gotten a raise, and so that had given him the confidence to maybe push that price point from $260,000 to $300,000. Well, what they could find for $300,000 was a manufactured home. And VA doesn't like manufactured homes very much.
Okay, but they will lend on them.
They'll lend on them, but the rates are a little bit higher.
Got it. So, in other words, when you switch from a stick-built single-family property to a mobile home, even if it's on a permanent foundation and it's treated like a house now, because it was a mobile home at one point, they'll do it, but you're going to take a hit in the rate.
They consider that a higher risk property because the buyer pool, the people that might be interested in buying a manufactured home, is lower than those that want stick homes.
Got it.
And so if they end up with the property back through default or foreclosure, it's harder for them to sell it. And so for that risk, they offset that with a higher interest rate, which puts the affordability even further out of range for this couple. So they actually found a house they liked, but they couldn't get comfortable with the payment and didn't end up purchasing that home. Then they sat for a few weeks.
So I just want to be clear on this. They found a house in that price range, in that stretch price range that they were going into.
Up to $300,000 now.
Right. And so now they found something like that, and when they ran the numbers, coupled with it already being a stretch, they ended up with a higher interest rate than they normally would have on a stick built, which pushed the payment even higher, putting them to a point of going, I'm not doing this.
Correct.
Is that fair?
And they were very discouraged, obviously. And so a couple weeks went by, we found this program, and I was, oh wow, they fit. And so we called back and we, had a conversation about the qualifications on this program. They met the qualifications, and they ended up pushing that price point up to $355,000. And with that lower rate, with that subsidized rate, the payment was even below what they expected it to be on a $300,000 house with that manufactured home I was talking about.
All right, so let's just pause there for a second. So they went from a $300,000 manufactured home that was probably in the sevens. Mm-hmm. Is that right?
That's
based
right.
on the rates. And so in those sevens, the payment was like, now they've gone to a $355,000 stick-built house.
At this 4.875 rate.
At the 4.875 rate, and the payment was far lower than what the $300,000 purchase was going to be. Was it more in line with what they were originally wanting to spend at the $260,000 range?
It was about where that $260,000 price was. So we got from $260,000 to $355,000 on this program.
Wow.
On a price.
Okay. Right now, obviously the type of house was a factor in there, but getting down into that $400,000, so they basically went back to the $260,000 price point, bought a house arguably worth more money, or at least able to, obviously
and
a higher
nicer
price.
Than the original homes that they were looking at, of course.
This is the perfect scenario in my head where a veteran is able to find a huge win. My feeling is those that serve the country, and because we're afforded the freedoms we are, because people lay it on the line, really should have some benefits. And I get frustrated sometimes that the VA's benefits have such large price tags, like that 3% for the funding fee, that hurts their ability to resell or eats at their equity. So when we find these programs where there's a real a distinguishable advantage, I get excited, because I think they should have a distinguishable advantage. I think for what they did, they should get a price break. They should get advantages. And so anyway, this is like really exciting. So we went to 4.875 on the rate, and what other things did they need?
Well, the other qualifications are that their income cannot exceed $130,000.
Got it.
That's the cap on the income. You can't make more than that. If you make more than that, you do not qualify for the program. It's not that they don't qualify for VA financing. The secondary subsidy rate limits the income to $130,000.
I was going to say, you got to make that distinction, because if you say I can get a $700,000 property with no money down, and you can't make more than $130,000, how do you pay the bill?
Yes, exactly. So that's not VA. If you do a regular VA loan, you're going to have a higher rate. But you can certainly make more than $130,000.
Got it.
And the property type is limited.
Okay, so
you can't have a manufactured home. It has to be a stick-built home.
What about condos?
Yeah, you can do a condo on
it.
Condos are no problem. What's the other limitation? The other limitation is you don't have the ability to co-sign on this loan.
Okay, so if your debt to income ratio isn't quite
right, and you
there,
got a family member that was willing to help you out, you can't do that on this loan. They don't allow for non-occupant co-signers on this loan. So those are the basic limitations. But I mean, that encompasses a pretty wide swath of the veteran population that I think are having the most challenges in affordability, and that's the folks that are not yet in the housing market but are trying to get in and own their first home.
Got it. Okay, so last question on this, where the income cap's at 130, is that a household income?
Yes, that is household income. It is. So it doesn't matter if your 18-year-old daughter is working as a cashier at Kroger, that income goes in. Or if your wife, who maybe is not on the loan, but has a job, that is, that's going to go into factoring into that $130,000 for qualifying purposes. It is household income.
Well, that's interesting.
Yeah.
I guess if there were ever a reason to want to throw a kid out, be like,
that'd be why.
You're 21 years old and you get your own place.
Yeah.
Because then we can qualify for, in this particular instance, which may not be duplicatable for somebody else, but 4.7, in the 4 3/4 price point. That is just absolutely massive.
It is.
And so what I'd like to say to the audience out there is, if you're a veteran and you're interested in this program, just want to find out more information, please go ahead and reach out to us directly, or you can reach out to Chris Coulter and just check what that qualification looks like, and to explore. It never hurts to ask, can I qualify for this program? I think it's worth the conversation. That being said, now in the last segment of this particular interview, what we want to talk about is the other major thing in the room, right? We've gone from what veterans qualify for to special program to cut down on rates to get affordability where it needs to be. Now we have to go to the, should I just wait until interest rates come down and be able to do this program to get it into that situation? Now, this part of our broadcast really will cover everybody, right? Because this is the conversation about, should I wait or should I move? And so where we sit today is we are at the end of July in 2024 when we're shooting this video. So this information will be very market relevant to today, subject to change. Tomorrow, the Fed meets and is starting to have the conversation. What the market is anticipating and hoping for, praying for, and believing for is that the Fed will say in September, we will officially cut the rates. Now, if they change that and move it, it's more of the same. But if they actually say that, Chris, what could happen?
Well, you definitely could see some optimism in the mortgage market. The mortgage market is, and the way rates are set, are certainly influenced by the Federal Reserve and what their policy is and what they do. But it's not the only thing that factors in. A mortgage is a security, is a commodity that's traded on Wall Street amongst investors, and so it can change on the daily. The market that trades and sets prices for rates will become optimistic upon the Fed's comments, depending on what those comments are. That optimism will feed into whether people want to buy mortgage-backed securities and therefore lower rates. So you could see a rally in that market after Wednesday that started rates in that direction. Because once they have a pretty high level of certainty or idea, or the percentage chance is greater than, say, 50% that the rate cut is going to happen in September, they will begin trading on that as if it were reality, and then rates will follow and start to go lower. So you could see the beginning of a rally as early as the middle part of this week.
Okay, so I want to unpack that, because if you've seen some of my other videos, you've seen me talk about this topic probably 4 or 5 times, but it's worth mentioning again. I just want to be clear about this. The Federal Reserve, what is known as the federal fund rate, does not set interest rates directly for mortgages. What it does is it sets the interest rate at which banks borrow money from the Federal Reserve to be able to loan you. Yes, entirely different video to talk about the fact that the banks are not loaning you money that they have, right? Whole different conversation. But they're borrowing money from the Federal Reserve. If that rate is, which today it's somewhere in the 5s.
Yeah, it's in the 5s.
Yeah, so we're let's just say it's at 5 flat. If that's the Fed fund rate, the reason rates won't go below that, generally speaking, is because then the bank that's loaning you would be losing money making a loan to you. They're in the business to make money. So if they have to borrow at 5, they have to charge you 6 6 3/4, 7 1/4, 8% to make money on that, in addition to whatever fees they charge you on the front end. So what Chris was just outlining is the secondary market, the bond market that buys these mortgage-backed securities. If their optimism increases and they start gobbling these things up, a demand for them increases, what will happen is that rate, that swing between 5 and 8 will come closer to the 5. It will come down because confidence is high. It probably won't go below it without a federal subsidy. I know somebody in here is going, you just talked about a 4.7. Well, yes, we did. But remember, there was money, government money allocated by Congress making that possible. Barring that, that's how rates go. So if the Fed comes out and says, we're going to go ahead and lower rates in September, then what likely will happen is consumer confidence will increase on the bond market. The bond market will improve, causing rates to come down further. So as of today, I think your conventional 30-year is somewhere about 6.875 to 6.625, depending on what kind of points that you're going to pay on it, and is what we're generally seeing. If the market gets better, it'll probably rock closer to that 6.75 to 6.5 range ish. Now, when they actually lower the federal fund rate on top of it, now what would happen in that scenario? Let's just say we get to September and they cut it, let's just say a quarter point.
Right. So when you see a movement like that, I mean, it's not going to get rates down into the 5s, yet it's not going to break the 6% mark most likely on this first cut. It's going to start to move them in a positive direction, which is, what we're looking for. 6.5 is realistic, I think, to that kind of movement from 6 3/4 to 6.5, 1/4% in rate right off the bat. Now, that may not sound like a lot to a consumer. To a mortgage lender and to a realtor, it's a very large change from where we have been.
Okay.
That will break the seal. When the seal is broken, I think over time you'll see it start to begin to settle in that direction. All we've seen for 2 years is up, up, up with very little relief. Now you're going to start to see some policy that pushes rates in the downward direction. When they break that seal, I think you're in for a general decrease in rates over the course of the next. This is it's not going to happen over, in a 30-day period or a 60-day period. We're going to get better rates, but we're not going to get a percentage point below or 2 percentage points below. That type of change is likely to take more like 6 months to a year.
Got it. Okay, so that being said, here's what I want to tell you from a realtor's perspective, from a broker's perspective. If rates start to come down and 6.5 becomes the ceiling, and then stuff starts to trickle its way down into the low 6s, headed towards the 5s on this, what you're going to see is a lot of people that sat on the fence jumping into the market. I've already told you at the beginning of this broadcast and on the live broadcast we did earlier this week with Trend Talk that we've experienced appreciation, large single-digit appreciation still this year, over 4% on average in the Cherokee County area. If that continues, you're going to start seeing a race for the limited amount of inventory, and prices will go up. I believe the comment I've put in the past is if we hit the 5s in some way, add $10,000 to the price of everything. So by buying today, you're going to lock in a rate that is okay. But when those rates drop, you're going to save what you would have paid extra by waiting. So if you can buy a house for $10,000, $20,000 less, whatever it is, by buying it today, sure, you might end up with a 6.875 rate, which isn't great. But when they fall into the 5s, you can refinance and still take advantage of that without having to have paid that $10,000 to $20,000 difference in price. It's going to take a decent amount of inventory to cross that 6-month threshold to cause prices to fall. Prices falling have less to do with interest rate and more to do with inventory percentages by a long shot. So any final words you want to leave people with on this program?
Yeah, if they want to calculate the cost of waiting, we can put actual numbers to that. And so like you mentioned some very general numbers in terms of $10,000 and $20,000 in the price difference between waiting, or buying this year versus waiting a year from now. If rates are lower a year from now, then you might have some savings on a mortgage, but that appreciation or the cost of that house being $20,000 more is going to outweigh any benefit you might have for a interest rate that is a percentage point lower than it is right now.
Right, and we can even quantify that pretty easily. So, like, if you're going to get a quarter point, what's a quarter point going to save you in a general $400,000 loan?
Yeah, so that's going to be about $70 a month.
Okay, so 70. That sounds almost ridiculous when we say that. $70 a month, so $740 a year in savings. Even the cost of a refi. Now, I know you guys have a no lender fee cost to a refi, but
Correct.
Let's just say it's $10,000 for a closing cost and a refi if they went to a general bank and didn't have it. So now you're at a total of $740 plus $10,000, even if you're going to add that on there. If prices went up $10,000, you're at a flat even on this.
Right.
In terms of the difference in there, if it went up 20, you save $10,000. Now, in your particular instance, you guys are doing
not to mention the fact that you've got interest that's deductible, and you've got the pay down of your debt, so your monthly payment's actually going towards something rather than somebody else's mortgage or somebody else's rent.
Right.
And you've got, again, that interest deductibility can be significant, offset to what what your actual mortgage payment is when you compare it to somebody who's in a rental situation where they're renting and not getting any benefit for that.
Yeah, and so this goes to that video we did, and we'll put a link in the description below about the profit centers of owning property, which is going to be appreciation, debt reduction. If you're not doing investments, you have depreciation, which you're not going to have that here, but you have interest write-off is what it replaces it with. So, for example, if you had $10,000 in interest in your payments per year and you're in a 25% tax bracket, that's $2,500 in actual dollar-on-dollar savings in your bank account, meaning you literally will, if you paid everything in that you had to the federal government, you would get a $2,500 better return, money coming back to you, or you just avoid having the bill to begin with. But that is a savings. Plus, now that you're paying in on the property, meaning even in those first few years where very little goes towards principal, something still does. And as you get further down in there, it starts to snowball how much goes towards principal. So you have debt reduction going in there. And then anything you do to the property when you're in it in improvements is another way. So all these things collectively make a value go up versus you waiting to do any of that stuff, taking advantage of none of those things. Buy today is really kind of a big deal. Just buy what you can afford.
And the last thing I'll say is, a lot of this is, we talk about this in the context of investment and numbers so often, and you have to make a good decision in that regard, and you shouldn't buy things that you can't afford if it fits into your budget and everything else. But at the end of the day, the thing that I think makes owning a home so unique is, in addition to it being one of the best and safest investments that you can put your money towards, it's also the place that you raise your family and that you recharge your batteries and that you make memories and that it's unique in that you use it every single day. And I just think that makes that investment unique. And I don't think you can ignore that when you're deciding and what your motivation is to getting into the housing market. I think that plays a big part of it. And so I think a part of it has to be made with that investment mind and that type of decision making. But at the same time, there's another element to this that I think you have to consider, and that's the practicality of what you're actually buying is just the most useful thing in addition to the largest investment that you'll make.
Yep. And I'll say this to anybody who's renting out there: if you're renting, you're paying 100% interest. So if you come in and you pay 7% interest versus 100% interest, you have just improved yourself by 93% less interest that you're paying. That's really a good way to look at it. For those of you stuck on the fence with a 3% mortgage and you don't want to get a 6%, obviously it's a different conversation. And that's just, if that property works for you, you'll continue to enjoy that appreciation. But if you have to make a move somewhere, like your life, your job, your career, you may want to consider that now, because whatever you're going to buy later is going to be higher. And if you're buying more expensive than what you currently have, whatever you're gaining over here, you could lose over there. So you may want to run those numbers and work it out. Now, if you're downsizing, it may work out in your favor just to hang tight, and we can walk you through those specifics, give you an individually tailored number plan so you can go, okay, for me, it makes sense to do this. We're vested in you having the information to make the best decision for you, not the information to make the decision we want. If you're not currently a homeowner, we highly, highly encourage it. It is a great way to build wealth. So with that, I just wanted to say thanks for the time. I think that this is the information and the conversation people really want. And I love the fact that you left them with build memories, because that's a big deal.
No doubt about it. Thanks for having me on, and I always enjoy talking about this stuff. So anybody that wants to call and continue a conversation, I'm happy to sit down and talk, regardless of whether we're pulling credit or doing anything like that. Always interested in conversations like this.
All right, awesome. Thanks so much, guys, and we will talk to you soon.